So everyone, welcome back to Corporate Decoder. Today we're diving into a report from Clene Inc. And it's not quite the feel-good story you might expect from a company name that sounds so clean. Let's just say someone's paying off their debts, but not in the way you might think. Clene Inc. filed a report with the Securities and Exchange Commission, also known as the SEC. These reports are required so the public can see important information about companies that sell stock. The big news here is that on March 26, 2025, Clene Inc. made a deal to take care of some debt. They basically gave away some of their stock to someone they owed money to. The company had $105,000 in debt, meaning they owed this much money. To get rid of this debt, Clene Inc. issued or created and gave out 35,311 shares of their common stock. They gave these shares to the person or company they owed the money to. The stock was valued at $3.54 per share, so in total the shares were worth $125,000, the amount of debt that was paid off. It's like trading something you own, your company stock, to get rid of something you owe, your debt. These shares were issued under a registration statement, basically a permission slip from the SEC that allowed Clene Inc. to sell these shares. Now, let's talk about what this really means. Issuing shares to pay off debt is kind of like using your credit card to pay off another credit card. It solves the immediate problem, but it can have some bigger consequences later on. First, it dilutes the value of existing shares. Imagine you have a pizza cut into 8 slices and you own all the slices. Now, suddenly the pizza is cut into 12 slices, but you still only own 8. Your slices are smaller, even though you still have the same number. That's what happens when a company issues more stock. Each existing share becomes less valuable. Second, it can signal to investors that the company is struggling to manage its finances. If a company can't pay its debts with cash, it might make people wonder how healthy the business really is. It's important to note that a law firm, Holland & Knight LLP, provided a legal opinion about the shares. This opinion, filed as an exhibit, essentially confirms that the shares were issued legally. Now, let's step back and put this into perspective. Clene Inc., based in Salt Lake City, Utah, is a biopharmaceutical company. Biopharmaceutical means a company that develops pharmaceutical drugs. They're working on new ways to treat neurodegenerative diseases, which are diseases that affect the brain and nerves like multiple sclerosis and Parkinson's disease. Diseases that affect the brain and nerves like multiple sclerosis and Parkinson's disease. I find while their work in this area is promising, the financial situation isn't quite as rosy. Clene Inc. stock trades on the Nasdaq Capital Market under the ticker symbol CLNN. So, what does this all mean for investors? Well, this stock for debt swap could be a short-term fix for Clene Inc., but it also raises some questions about their long-term financial health. Cool, but now, let's transition into an opinion and analysis of Clene Inc. Clene Inc. appears to be at a critical juncture. Their focus on neurodegenerative diseases offers a potential path to success, but it is also fraught with risk. The recent decision to issue stock to cover debt suggests the company is facing immediate financial pressures. While this move might offer short-term relief, it's essential to consider the long-term impact on existing shareholders. One of Clene's strengths lies in its commitment to addressing complex medical conditions. If their research yields positive results, the company could see substantial growth. However, the biopharmaceutical industry is highly competitive. There's always a risk that other companies could develop similar or more effective treatments. One notable risk is Clene's reliance on external funding. Drug development is expensive, and if the company struggles to secure additional financing, it could face significant challenges. In conclusion, Clene Inc. presents a mixed bag. There are opportunities for growth but significant risks. While the company's stock traded for about $3.50 share, investors should carefully weigh the potential benefits against the very real challenges. Thanks for watching. If you found this breakdown helpful, please give us a like, leave a comment, and subscribe for more insights into the world of corporate filings.